Today, we are going to break down an amazing book called The Accounting Game. The whole idea is to show you how something as simple and fun as a lemonade stand can pretty much explain everything you need to know about accounting. So let's get right into it.
I mean, be honest for a second. When you hear words like debits, credits, or balance sheets, does your brain just kinda shut down? For so many of us, it feels complicated, maybe even a little scary. But what if I told you it doesn't have to be like that at all?
Well, that's the magic trick behind the accounting game. It takes all that confusing jargon and flips it on its head. It turns it into a story that we can all instantly understand, just starting a little business on a hot summer day.
So right off the bat, we need to change how we think about this. Accounting isn't some boring, dusty old subject. Nope. Think of it like a game. And accounting? It's just the rule book for keeping score. Are you winning? Are you losing? The numbers will tell you the story.
All right, so every great business story starts in the same place. Before you can make a single dime, you need some money to get started. So let's roll up our sleeves and build our lemonade empire from the ground up, step by step.
So, put yourself in this scene, right? School's out, the sun is blazing, and you've got this killer idea for a lemonade stand. But here's the thing. Ideas are great, but they don't buy you lemons. You need cash. So you dash to your room and grab that piggy bank.
And there it is, $5. It might not seem like a lot, but this is everything. This is the seed money for your brand new empire. It's the very first investment you're making in your own business.
Okay, so how do we keep track of this? The book gives us the super simple idea, a scorecard. Just grab a piece of paper, draw a line right down the middle. On the left, we're going to list everything the business has. And on the right, we'll list who has acclaimed all that stuff. Or, put simply, who owns it. So, the very first thing we write down is easy. Under what we have, we put down $5 in cash. Simple enough. And on the right side, who owns it? Well, you do. It's your cash, so we'll call that your original investment. And look at that. $5 on the left, $5 on the right, it's perfectly balanced. Remember that. It's going to be a big deal.
And that thing we just called original investment, well, it has a fancy accounting name. It's called owner's equity. Just think of it like this. It's your slice of the pie. It's literally your skin in the game.
So you do the math and, yeah, $5 is not going to be enough. Not for premium lemons anyway. So you do what any smart entrepreneur does. You go find some investors. In this case, your personal bankers, mom and dad. And they agree to give you a $10 loan.
Okay, let's get back to our scorecard. On the left side, our cash just jumped from $5 to $15. Awesome, right? But wait, someone else now has a claim on our stuff. We owe mom and dad $10. So on the right side, we have to add that IOU. The official term for that is notes payable.
And that brings us to our next big word, liabilities. Don't let it scare you. A liability is just a fancy word for a debt. It's what the business owes to other people. Right now, that's the $10 you owe your parents.
Okay, let's just pause for a second. We've got cash, we've got your investment, we've got a loan. And if you've been watching closely, you might have noticed something kind of magical happening. Everything is perfectly balanced.
This right here is the absolute core of everything. The one rule to rule them all. The left side always, and I mean always, equals the right side. No exceptions. It's like the law of gravity for business. It has to balance.
All right, we've been using our own simple language, which is great for understanding the stuff. But now, let's swap in the official pro-level terms. What we have, that's your assets. And who owns it? Well, that gets split into two groups. Liabilities, which is what you owe others, and owner's equity, which is what's yours. And when you put those official terms together, you get the single most important equation in all of accounting. Assets equals liabilities plus owner's equity. That's it. Everything you have is funded by either someone else's money or your money. It just has to balance out.
And guess what? You didn't even realize it, but you just made your very first real deal financial statement. This scorecard, this snapshot in time, that's a balance sheet. See? Not so scary when you build it yourself, is it?
Okay, so we are funded. We've got $15 burning a hole in our pocket. Time to go shopping. We spend $12 on a whole bunch of lemons and sugar and cups. So, what does that do to our perfectly balanced sheet? Now watch this part closely. Our cash, which is an asset, just went down by $12. But did we lose anything? No way. We just swapped one asset for another. We traded our cash for a new asset, inventory. So look at the left side. The total value is still $15. The golden rule is safe. We are still perfectly in balance.
All right, this is it, the moment of truth. The sign is up, the lemonade is chilled, and we're ready to go. We are officially open for business. Time to turn these lemons into some serious cash. And boom, the day is a massive success. You've got a jar full of cash, a total of $25 in sales. Now, is that all profit? Well, not quite. We have to subtract what it cost us to make the lemonade we actually sold. So let's say the ingredients for those drinks cost us $10. That's our cost of goods sold. You take your sales, subtract that cost, and what's left over? A sweet $15 in gross profit. That's what I'm talking about.
Whew, what a day. You are exhausted, but you've got a big smile on your face. Now for the really fun part. Let's go back to our scorecard and see the story of what we just accomplished. So we have this new $15 profit. Where does it live on our balance sheet? Well, think about it. Is it a loan? Nope, you don't owe it to anyone. Is it a new investment from your piggy bank? Nope. This is money the business itself earned. And since you own the business, that profit belongs to you. It beefs up your slice of the pie. It gets added right into your owner's equity. We call it earnings.
And this, right here, is the whole point. You see, accounting isn't just about looking backwards at what you did. It's the living, breathing story of your business. It's a map that shows where you came from, the challenges you overcame, and the value you created. It's not just numbers on a page. So the real question is, what kind of story are you going to tell?